Good afternoon, DEC members. Happy Thursday to you. I'm Steve Gregorian, President and CEO of the Detroit Economic Club. It's a pleasure to have you with us today. And if you haven't already, please do mute your audio and video. A couple of quick announcements before we get started. I do want to take a brief moment, always, to thank the 120 terrific DEC sponsors for the support of our mission. And also, please be sure to get your ticket for our next two upcoming speakers. Next Thursday, October 15th, we're pleased to host Sal Khan, CEO of Khan Academy, who will offer his thoughts on virtual learning with tips for parents, students, and educators alike. October 20th, President of the Federal Reserve Bank of Chicago, Charles Evans, will share his thoughts on where our economy is headed. I do want to offer a special welcome to college and high school students who are always near and dear to the DEC. Today, we are joined by students from Schoolcraft College, University of Windsor, Northville High School, Dearborn Divine Child High School, Hazel Park High School, and most importantly, the best darn students in the world, which also happens to be my alma mater, students from Albion College. So hello to all of you. Thanks for being with us. Here's the format for today's meeting. I'll interview our speaker for 20 minutes. And for the final portion, we'll get to questions that you submitted either via email and that we want you to submit questions real time today via the chat room. Once we say goodbye to our guest, we hope you'll all stay for a 15-minute virtual networking session. And finally, the DEC has an incredible history of speakers that we love to share. October 8th is a really cool date in our 86-year history. Our speaker today joins a distinguished list of 10 others who have addressed the DEC on this day, and a few highlights from this group, really cool. 1945, World War I flying ace Eddie Rickenbacker addressed the Detroit Economic Club. 1985, popular TV host Phil Donahue. 2013, Home Depot co-founder Bernie Marcus. And just last year on October 8th, 2019, Mike Corbett, the CEO of Citigroup, addressed the DEC. And today we're pleased to add Mark Zandi as our 11th speaker on this day in our DEC history. So let's get started. Mark Zandi is Chief Economist of Moody's Analytics, where he directs economic research. He is a trusted advisor to policymakers and an influential source of economic analysis for businesses, journalists, and the public. He frequently testifies before Congress and is often quoted in national and global publications and appears as a frequent guest on CNBC, NPR, Meet the Press, CNN, and various other national networks and news programs. Dr. Zandi earned his Bachelor of Science from the Wharton School at the University of Pennsylvania and his PhD at the University of Pennsylvania as well. It's his second visit to the DEC, with the previous one happening in 2011. So Mark, really great to see you again, and thanks for being with us today.
Sure thing, Steve. Thanks for having me. 2011, I think we were having the same debate we're having today about fiscal policy. It hasn't changed one bit. Hard to believe.
That's amazing. Well, we've got a few minutes to cover a bunch of topics. So let's get started, Mark, by asking you to put the last 6 months of our economy into historical context.
Well, Steve, I think it's fair to say the last 6 months have been unprecedented. The recession, March, April, was the shortest in, I think, our economic history. I think the typical recession since World War II is about 9 months in length, so 2 months. But the most severe, by my calculation, the peak to trough decline in GDP was about 14%. And just for context, in the financial crisis, a little over a decade ago, the peak to trough decline in GDP was about 4%. So this is, by that measure, 3 times more severe. We've got some of that back, about half of that back, half that GDP back. But we got a long way to go to get back to where we were pre-pandemic. And, you know, in terms of jobs, we lost 22 million jobs in March and April. We've gotten 11, 12 million of them back. So, you know, that just shows you how far we have to go. The other unprecedented aspect of the last 6 months is, I'd have to say, the policy response, the response by the Federal Reserve, monetary policy, very aggressive, dropping rates, lowering capital reserve requirements for banks, QE, and probably most importantly, resurrecting and inventing a whole slew of credit facilities to insulate the financial system from the chaos in the economy. The Fed's done a very good job, and lawmakers deserve some credit too. I think up until recently, they've been put on the accelerator, the CARES Act. The fiscal policy support has been very substantive, 12, 13% of GDP, which is even more than the fiscal policy support we got back in the financial crisis. So I think the word unprecedented sums it up nicely. The last 6 months have been unprecedented.
Thanks, Mark. So you started to give us your thoughts on the current state of the economy, but maybe I would ask you to talk about the pace of the recovery and what's standing in the way of a more rapid pace.
I think it's slow and fragile. We got a nice bounce back when businesses reopened across the country, beginning in late April through late June. But since then, we've been growing, but at I'd say a halting pace. We put together this what we call a back to normal index. We constructed this with CNN. It's a compilation of 40 or so different economic indicators. Some of them come from the government, tried and true measures of economic activity. Some from third-party sources, everything from the home-based data to the Google mobility data. And that shows precisely that pattern. Big decline March, April, got that bounce through late June. Since then, we've been going more or less sideways. And I think that's how it feels like to me. You can feel it in the job numbers. The job numbers are starting to throttle back. We got almost 5 million back in June. We got 670,000 in September. And my guess is if we don't get any additional fiscal support here, we may see some negative numbers by the end of the year, early next. So it's a very fragile economic recovery, and obviously lots of risks. The pandemic is still raging. And so as long as that's the case, I think we have to be very cautious and circumspect about our prospects.
Let's talk about, you mentioned perhaps another stimulus package. Let's talk about that a little bit. What trillion number makes sense in your mind? And what are the elements of an aid package that have to be there to help most people?
Well, from a political perspective, I think the answer is 1.85 trillion to be precise. I mean, the Senate Republicans, the administration, I should say, they were coalescing around 1.6 trillion. The House Democrats were coalescing around 2.2. Feels like to me, the answer is 1.85. Come on, guys. Let's do that. From an economic perspective, I think the Fed Chair Powell said it nicely when he spoke before NABE. He said, we can't overdo it here on fiscal policy. We're a long way from getting back to full employment with a 7.9% unemployment rate and a labor force participation rate that's 2 points below where it was pre-pandemic. And so, foot flat on the accelerator. And by the way, guys, interest rates are, have you noticed, zero? And they're going to stay there for a long time. So let's get going here. So 1.85 trillion seems like a pretty good number to coalesce around and would make a lot of sense. In terms of what that should include, I think broadly speaking, 3 things. One is more additional support to the unemployed and folks that are stressed financially, low-income households. That stimulus checks, not my favorite way of helping, but we've gone down that path once before. We've got the systems in place. Let's do that again. Some additional UI, supplemental UI, maybe not $600 a week, but good compromise would be $400 a week. Second, I think we need state and local government support. I mean, that's tried and true. We've done this every recession. It worked very well coming out of the financial crisis. If state and local governments don't get support, given the budget holes they have no choice but to cut jobs. And that's where the job losses are going to start to show first if we don't get a fiscal package here. And programs. So, that's, direct hit to the economy if we can't help these state and local governments out quickly. And finally, the third part of it would be PPP money for small businesses, additional money for the airline industry. Obviously, we don't want to see that evaporate in this chaos. The healthcare industry, housing support, rental support. We've got a lot of folks that are not being able to make rent payments, and the back rent is accumulating very rapidly here, and that's going to be a problem when the moratorium on rent payments comes off. So the potpourri of other things, but you do the arithmetic, you can come up to 1.85 trillion pretty fast.
I hope this isn't the case, but if we don't get a package passed, Fed Chairman Powell earlier this week, I think, warned of prolonged economic pain. What's your thought? What's it look like if we don't get another stimulus package?
Well, it's bad news. There's no upside to that. It's all downside. My sense of it is, and I alluded to it earlier, is that if we don't get any additional fiscal support, let's assume they figure out a way to help the airlines. Let's just put that off the table. That feels like they're going to do that, but that's all they do. And if you told me, Steve, that by December, January, we were seeing job losses again and rising unemployment, I wouldn't be surprised. That feels like the kind of scenario we face. And that assumes that the pandemic doesn't get worse. If the number of infections here continue to move north, which they seem to be doing, and clearly the healthcare professionals are very nervous about another wave of infections and the healthcare crisis intensifying, that would only exacerbate the economic problems. There's a very clear link between the healthcare crisis and the economic crisis. You can draw the lines very clearly when you look at the data at a state level. So I think that's a problem. I will say, if that's the scenario, I would be shocked if on the other side of the next president's inauguration, we don't get a big package, whether it's President Trump or President Biden, Republican Congress or Democratic Congress. In that kind of economic environment, I would anticipate we'll get that 1.85 trillion. So, go figure. Why not just do it now? Save us this pain and suffering. But no, that doesn't seem to be the way this is going to work out.
Back to recovery for a second. Let's play the alphabet game. In your opinion, is the economic recovery more like Trump's V-shaped thoughts or Biden's K-shaped, or maybe a different letter?
Well, it's not V-shaped, that's for sure. this is not V-shaped. This is a slog. Even if everything, the pandemic doesn't re-intensify here, let's say we've seen the worst of it, and even let's assume we get some vaccine or vaccines that's reasonably effective, widely distributed by mid next year. This is going to be a process to get back to full employment. And my best guess is, if everything kind of roughly sticks to script, lawmakers don't mess this up anymore, the Fed remains aggressive, which I think seems like a very likely thing. It's not until late 2023 before we get back to full employment. In my book, a full employment would be consistent with a 4%-ish unemployment rate, somewhere around there. I'm assuming the labor force participation is not going to get all the way back to 63% plus is where we were pre-pandemic. I don't think we're going to get back there, but 62 and a half, that would be full employment. So this is not V. And I think the risks are to the downside until, policymakers kick into a higher gear and really, come forward with some additional fiscal support. Until that happens, the risks to that late 2023 full employment outlook is, I think, quite significant. So it's not V. K seems more reasonable, more representative of the reality of what's going on. I do think we've got this real bifurcation in how different parts of the economy have experienced the pandemic and the fallout. You can see that with regard to low income households versus higher income households, minority groups versus everybody else, folks that live in urban areas versus those that don't. You can see it in, the housing market doing great, surprisingly well for various reasons, but commercial real estate's getting creamed. You can see it across industries, the obvious industries on the front lines here, retail, restaurants, recreation, transportation, healthcare getting crushed, whereas technology and online retailers and Home Depot and Lowe's doing fantastic. Retail sales are V-shaped, they're back, but consumer services are, in the dumper. It's actually, this is why there's so much debate about the health of the economy, because it depends. I think the metaphor is the economy is an elephant. Depending on which part of the elephant you touch, you get a kind of a different picture of things. So you got to take a big step back and take a look, and it feels more like K-shaped is the best way to describe what's going on.
Thanks, Mark. I want to remind folks to send a question into the chat room. We're going to get to those in a few minutes. I've got just time for a couple more with Mark. Mark, your recent report highlights Trump and Biden's differing economic plans. And in that report, you state that VP Biden's plan will add more to the economy. Explain, please, and in your opinion, which one lands us in a better place in 4 years?
Sure. And I should say, Steve, for folks, if you want to see the gory details, just Google Zandi macroeconomic consequence of Trump v. Biden, and you'll go right to the paper and you can see all the gory detail. But we run 4 different scenarios based on the election outcome. Let's just bookend things. On the one side, is Biden wins and it's a Democratic sweep of the Congress. And on the other end, Trump wins and it's a Republican sweep of Congress. If that's the 2 scenarios we're considering here, the D sweep lands the economy in a meaningfully better place 4 years from now than the R sweep. 3 key reasons for that. One is fiscal policy. I've been making a strong case, I think, that the appropriate fiscal policy here is foot flat on the accelerator. And, Biden, that's what he does. If you look at his proposals, he does propose raising taxes on folks that make over $400K a year in large corporations, using those funds, about $4 trillion over 10 years, to partly pay for about $9 trillion in increased investments and spending on infrastructure, education, healthcare, housing, elder care, child care. I can go on. But the net of all that is he's going to need to borrow money, and that's deficit finance spending, and a lot of that on those investments early on in his administration. That's the kind of fiscal policy we need to get back to full employment as fast as possible. President Trump, much more, very different kind of policy. I'm going to cut taxes for the folks that I previously cut taxes for generally. He has talked about infrastructure spending, which would be good policy. Wasn't able to really follow through in his first term, but maybe he could do that in the second term. And then he's also talking about cuts to everything else, discretionary spending. Second key reason is trade. In my view, tariff wars, trade wars are not productive. They don't accomplish anything, and they act like a tax increase on American business and consumers. And the American economy coming into 2020 was already quite weakened by the trade war. You in Michigan know this quite well. Manufacturing, agriculture, transportation, all were in recession, coming into 2020 because of the tariff wars. Third big difference is immigration policy. President Trump will double down on restricting immigrants, and Biden would, at the very least, normalize immigration policy. And in my view, immigration is the American economy's secret sauce since the founding of the country. Not only in terms of we track the best and the brightest, but and we need those folks to grow our economy. They're key to the labor force. It's the key difference between the United States and Japan is immigration and allowing those people to come into the country. But they're also key to productivity growth. I mean, by definition, immigrants are risk takers. They start companies at a higher rate than natives, and that's vital to our comparative advantage as a nation. So I can go on, and you can go take a look at the study. But in my view, D sweep would land the economy in a meaningfully better place than an R sweep by the end of the next president's term.
Thanks, Mark. I did look at that report, and it's very well laid out. I would encourage our members to take a look at that as well. So, all right, just got time for one more question before we get to the audience. And the drum roll, please. The Detroit Economic Club, Mark, awaits your prediction on the answer to the title of today's program. And the winner is, so tell us who and why.
Okay, let me get to it in just a second. I've got a model for everything. As you know, I've got a model to predict the presidential election. Again, Google Zandi presidential election model. You'll see all of the gory details behind the model. Everything is very transparent. Electoral college level, state level, left-hand side for all the economists in the room, the percent of the vote that goes to the incumbent party, that's President Trump, R. Right-hand side, bunch of political variables to capture previous voting patterns. One interesting point, one of the key variables is the president's approval rating, but it's not the level of the approval rating. President Trump's is obviously very low. It's the lowest of any president on average in his presidency since polling began, in earnest since Harry Truman. But what really matters is the stability of that poll approval rating, and obviously President Trump's approval rating has been very, very stable until very recently. And then a bunch of economic variables, as you would expect: unemployment, house prices, gasoline prices, real incomes. One key point there: stock prices have taken on an outsized role, much more important. Maybe in part because President Trump seems to be shining a light on stock prices as a barometer of how the economy is doing. But also I think it's because boomers, I'm a boomer, we're in our 50s, 60s, and 70s, focus like a laser beam on our nest egg. And a big part of that nest egg is stocks, and we vote. And so if stock prices are down, it feels pretty depressing. When you see green on the screen, you feel a lot better, and that will be reflected. Anyway, you do the arithmetic, run the models. The winner is Biden wins, but it's very close. It's under typical turnout. Turnout matters a lot, but under typical turnout, he wins very much on the margin. In the key swing state, Steve, my home state of Pennsylvania, I live in Pennsylvania. I was raised here in suburban Philly. My kids joke that I've been sheltering in place all my life. This is where I've lived. And Steve, we've also done, and this is in the studies, a lot of work at the county level to determine which counties are key to these key swing states. Michigan's key also, obviously. Pennsylvania is more important in our analysis. The key swing county, Steve, is Chester County. That's my county. And here I'm only partially joking. The key street in Chester County is Laurel Circle. It just so happens I live on Laurel Circle. And I think this entire election, I'm telling you, Steve, revolves around my wife. So all eyes on my wife. Whatever she's doing, she's going to determine this election. So that's how close it is.
Well, let's hope she makes the right decision, Mark, whatever that is.
So,
and all eyes on Pennsylvania, on Chester, on Laurel Street, and on your wife and her decision. So thank you. So if you've got time, we've got a few questions from the audience. You touched on the stock market. Somebody asked, can you give us a quick outlook for stock markets if Trump wins the election and if Biden wins the election?
Yeah, in the paper, you'll see we also predict S&P 500 index. And under the Republican sweep, the stock market does better early on in the first year or two than under a Biden sweep. And the obvious reason being President Trump wants to keep the current low 21% corporate tax rate, and will also cut business taxes, accelerated depreciation, as part of his proposal in his next term. Biden would do just the opposite. He would raise taxes. He'd take that 21% tax rate. He wouldn't take it back to the 35 that prevailed before the Trump tax cuts, but he'd take it back to 28. And then he would get rid of a number of different tax advantages and breaks that were in the Trump tax cut, particularly around real estate and global taxation, that kind of thing. So if you just do the arithmetic, stock prices are equal to corporate earnings times a multiple, the price earnings multiple. If you assume the price earning multiple is constant, doesn't change, then if you just if you raise taxes, you're going to lower after-tax corporate earnings, so the stock price will go down. So if you just do that arithmetic, it will take about 5%, 6% out of the S&P 500. Just like the tax cuts put about 10 percentage points into the S&P 500. But by the end of the president's next term in 2024, it's pretty much a wash, because Biden, the stock market under Biden gets dinged by the higher corporate tax rates, but ultimately the stronger economy lifts corporate earnings, and you basically end up in the same place. So at the end of the period, I don't think you can go take a look. I don't think the S&P 500 is materially different. So it depends on your horizon. The other thing I'd say, though, quite interestingly, I don't know if you've been noticing the stock market recently, it's rising, even though the odds that Biden and the Democrats are going to sweep have also been rising. So if you look at all the betting markets and obviously all the polling, the probability that markets are attaching to a Biden win for sure and a Democratic sweep are rising. And despite that, the stock market's been headed north. Now, obviously, a lot of things going on, but one possibility is that people are starting to discount all the stimulus they're going to get under a Biden and Democratic sweep. Because if you get a Democratic sweep, the first thing that's going to happen is you're going to get a very large fiscal stimulus. It's not going to be 1.85 trillion. It's going to be 3 trillion, 3.5 trillion, something. They're going to take what Chair Powell said to heart, and they're going to push on that accelerator. And so that's going to push the economy up. So I could be wrong. The models could be wrong. We could see something very different here because of the fiscal support that is in the Biden plan. But just the arithmetic would say the higher corporate tax rate should ding stock prices at least early on.
Mark, we did get a question. You touched on the national debt. And here's a question that was emailed. The national debt has increased 7 trillion in just the last few years. How concerned are you about that? And doesn't additional stimulus packages just continue to add to that debt?
I'm very concerned about it. Deficit and debt are a problem. But unfortunately, because of the pandemic and its fallout, we have a Hobson's choice. We don't really have a good choice. There's no good choice. We're just taking the least bad choice. And in my view, that is use our resources now, get to the other side of the pandemic as gracefully as we possibly can, get back to full employment, and then pivot and address our fiscal situation. Then we focus on restraining government spending, increasing taxes, all of the above. Because if we don't do that, the other choice is to become more fiscally austere, like right now, which is kind of sort of what we're doing. And that's going to cause, in my view, the economy to struggle, and that is going to have negative consequences on our fiscal situation. More unemployment, underemployment, lower growth, lower corporate earnings, less income, less tax revenue, more government spending. So we're going to end up in a worse position fiscally if we don't be aggressive here. So, my view here would be a bit different. It would be a lot different if interest rates weren't zero and pegged and pinned to zero for the next 3 years. I mean, the Fed is saying, look, we're going to, they changed their policy framework. They're not going to raise rates until the economy is clearly at full employment and inflation is above the 2% target in a consistent way. And that's at least 3 years from now. So in that context, it just makes a lot more sense to put foot on the accelerator, get us back to full employment. And at that point, that's when you pivot. That's when you go from fiscal support, fiscal stimulus to austerity and fiscal discipline. We made the mistake of pivoting way too quickly. Back 10 years ago when I was at the DEC, we were having this debate, and we had moved from stimulus in 2009, a bit of stimulus in 2020. 2011, we started austerity. And that's one of the key reasons why the economic recovery coming out of the financial crisis was so poor, why it was so weak. We didn't keep our foot on the accelerator until we were back to full employment. And hopefully we don't make that same mistake again this time. So, but deficits and debt are an issue. And the last thing I'll say on this is I wouldn't be surprised if at some point, 2023, 2024, that there is going to be some kind of fiscal event. Because the other thing to recognize is this is not only an issue here in the United States, it's even much more of an issue overseas. Every country on the planet has been using deficit financing and debt to help bridge their economies to the other side of the pandemic. And so their fiscal situations are much, much worse than ours. So global investors at some point are going to say, hey, this is a problem. I don't think you guys are going to pay me back in a timely way. They're going to want a higher interest rate, and we're going to have some kind of fiscal event. So I think that's highly likely at some point, down the road, probably around the time we reach full employment, 2023, 2024, something like that.
Thank you. I'm going to break our rule, and it's 1 o'clock, but I'm going to ask you for one last question that we got via the chat room. And if we can just have you answer this. DEC member Marty B asked an interesting question. Would a Jobs Act be more beneficial than short-term cash in public's pockets? So in other words, money sent to businesses if they employ workers.
Well, in my view, we need to do both. We need the income support, support to small business, support to unemployed workers, while the pandemic is still disrupting businesses. I mean, the pandemic is still on, and big parts of the economy are still very severely disrupted. And in as long as that's the case, we need to provide that income support, that help to get them to the other side, that businesses don't fail, that people don't go into bankruptcy, that we don't get very severe credit problems. Once we're on the other side, then it goes from being fiscal support to this is just nomenclature, but I think it makes this whole thing more clear to understand. We go from fiscal support, that's what we've been providing so far, and what I'm arguing we should provide until the pandemic is over, to fiscal stimulus. Then you say, okay, we're on the other side of the pandemic. Now we want to get back to full employment as fast as possible. And then you focus on things that are going to be more like investments and lift jobs. And that's immediately go to infrastructure. That is, because that has high multipliers. It's going to create jobs for those people that have lost their jobs in the other parts of the economy. It can get to every community in the country because this is a coast-to-coast problem, and it has long-term economic benefits. We can all agree, I think, that our infrastructure stinks and we need to improve it. And it's not just roads, bridges, it's telecom, it's social infrastructure like our schools and our housing. There's a gazillion things we can do to improve, our infrastructure that will improve long-term economic growth. And also, education, I think, is a really good place to focus because that benefits us in the long run, raises the educational skill level of our population. And also our educational system is really troubled, right, on lots of levels. And after this mess, our higher education system is going to be really really in difficult straits. That business model was under pressure coming into this mess, and now it's going to be under extreme pressure. So and then once you get the economy back to full employment, inflation back close to target, then you start to normalize. Then you start addressing our fiscal problems. That's when you start to raise taxes. That's when you start to really rein in the spending, and you try to address those long-term problems and get our deficits and debt down. So if I were king for the day, that would be the script I would lay out, in terms of policy.
Well, Mark, thank you. We wish you could be with us every week. This has been absolutely fascinating. As always, we appreciate your time. Keep up the great work. We'll be watching you, and we hope to have you live and in person with us one day in the future soon. So thanks
please again. Bring that date closer. I can't wait. Yeah, can't wait to visit Michigan. Really can't.
Thank you. Good luck, Mark, and goodbye to you. Yes.
Bye-bye.
And thank you to all of my team, to all of you for being with us.